Hi, my name's Elliott Proctor, and I'm the lead developer of EWAVES, the world's most advanced Elliott Wave analysis software. Today, I'd like to talk about gold. Gold has been in the news a lot lately, and it's finally creeping up on investors' radar that gold has, in fact, been the top performing asset in the United States since the year 2000, this side of crypto, of course, which did not exist in the year 2000, but has massively outperformed stocks, housing, and of course bonds by a very, very large margin. Now, there are all kinds of reasons that I'm sure you've heard that gold has been increasing in price. And if we look at the fundamentals behind the move, it would be trivial for someone to say, well, this is simply because the US government has too much debt and they've been monetizing the debt. And by increasing the money supply, that's causing inflation and causing the price of gold to go up. And therefore, we should expect the price of gold to continue higher and higher and higher. However, I'd like to point something out. In Japan in 1989, the debt levels there were in fact 2/3 of their GDP and grew to well past 100% of GDP by 2000. And they went into a near 3-decade-long deflationary collapse, which included a huge amount of debt monetization by their central bank. And yet that did not ignite any inflation. Okay, so my point here about fundamental analysis is it's not that simple, and the market can easily go either way based on fundamental arguments. Obviously, if we have a deflationary episode, then it stands to reason that the contraction in private credit could greatly exceed any monetization by the Federal Reserve, thereby causing a net deflation. And it's also trivial to argue the exact opposite case of financial repression. So instead of sitting here and debating the armchair fundamentals behind it, let's go to technical analysis, specifically Elliott Wave analysis, and see what it has been saying about the gold market. Now, something interesting happened in gold in August in terms of price patterns. So I'm going to close out of gold here. Before I show you the wave count in eWaves Live, let's actually pull up some data, just raw data, so you can take a look at that. This raw data is through August 1st, and the reason I pulled up the data through that particular date is just because there's a very interesting price pattern here. Of course, trying to figure out what that price pattern is by hand is not always an easy task. If we put on our wave counting hats, we can start counting from the left. We see 1, 2, 3, 4, 5 waves up. So that would be our first impulsive wave. We've got A, triangle B, C. So that would be a correction. 3 waves down. We put your 2 here. And then clearly we've been in some kind of a third wave here because this is where there's a lot of price strength coming after the first 1, 2. All right, so that's very, very clear. And now what we want to know at this point is what's going to happen next. Are we going to get weakness in this market, or are we going to get strength in this market? So we really want to rely on the near-term pattern here. And you may recognize this pattern here. Again, put on your Elliott Wave counting hats. We've got some kind of a peak. We've got 3 waves down. We've got 3 waves up. You may recognize this as actually 7 waves. 1, 2, 3, 4, 5, 6, 7. That's a double zigzag as opposed to a single zigzag. Okay. Then another zigzag down, zigzag up, another zigzag down. What is this looking like? It's contracting here, it's contracting there. This is a triangle shape here, okay? And triangles are continuation patterns. They mean that this is some sort of a correction that the market is going to move higher, okay? Let's see what eWaves was saying on that exact same date so that we don't have to do this by hand. We can let a machine do it for us. All right, so I'm going to go in here and do XAU-USD to pull that up. And just so you know, the reason I like XAU-USD, this is a CFD or a contract for difference that trades on Forex, is that it very reliably tracks the price of gold, okay? Because it trades around the clock. And unlike futures, there's no premium or discount in the contracts that you have to account for that causes strange gaps that we have to adjust for. So it's a very, very clean representation of gold. All right, so let's go ahead and click on XAU-USD and see on that same date, August 1st, the same data we were looking at here in the raw view. In eWaves Live, let's see exactly what it was saying. All right, now let's zoom out one time here in this tool. Okay, because I want to start at that September date because that's the same date we started on the other chart. And if you remember that by hand counting we did, we said 1, 2, 3, 4, 5. And then we had our A, triangle B, C for 2, 1, 2, and then some kind of a third wave. And you can see this is not easy to do by hand, and that's why we have EWAVES, which does this for you automatically, okay? It's an advanced constraint solving software that knows the statistics behind Elliott wave analysis, and it gives you the most probable wave count and updates throughout the day. Now, one of the first things to notice about this wave count is inside of this third wave, okay, let's count it. We've got 1, 2, 3, 4, 5. Is that the fifth wave is very, very large, okay? Now, if you recall from the Elliott wave principle, usually it's third waves that are the largest, such as this sequence here. We've got 1, 2, 3, 4, 5, and 3 is clearly the largest in terms of price. However, in commodity markets, that's often not the case. In commodity markets, fifth waves are quite often the largest moves in the sequence. Okay, and that's because commodities often spike on fear. Gold goes up on fear of inflation and can have quite sharp spikes upwards. And these are very similar to the spikes downwards you see in equities, because downwards moves in equities are driven by fear and upward spikes in commodities are driven by fear. So it's a very similar emotion. Okay, so what does this spiky fifth wave behavior tell us about what's due for gold next? Well, as you can see back here in June of 2024, we had a triangle, and then we had a large fifth wave out of that triangle. And now EWAVES in August was showing us this triangle here, a much larger triangle, 1 degree larger than this, and pairing with this one too. So we've got 1, 2, 3, and 4. Okay, so that's saying we're due for another massive thrust up here in gold. And of course, if we go back to our raw data here, and then we zoom out, we can see this triangle in context. Here's the triangle, and then here, this point on, this is the thrust out of that triangle that we've had since. So it's been very large and a very dramatic move out of that triangle, exactly as EWAVES was predicting back in the beginning of August. Now, what is next for gold? You know, if we go back here, obviously we could continue our wave counting and count into this data. Now, I'm not going to do that for you today because that's reserved for paying subscribers. But if you go to ewaves.com, you click the join button, and then after joining, you can log in and you can see our live wave counts on gold. It'll look something like this, but updated all through the current day, and you will be able to see what our current outlook is. Well, gold certainly has been an exciting market, but for me, I'm more academic about things. You know, my day-to-day focus is not watching the market every second. I let EWAVES do that. My focus is on research. So I think now is a good time for an educational portion of the video. If you've done a lot of wave analysis, you'll probably already know everything I'm about to talk about. But nevertheless, just with this wave count here, there's quite a lot of interesting things going on. Well, of course, we're focused on this triangle as being the most recent opportunity in gold. If you look at this, another big opportunity was actually after this zigzag here, especially with this first thrust kind of out of the zigzag. I want to show you why, okay? Because imagine in real time the market's going down, okay, after this 5-wave move up. You've got this move down, you've got a clear triangle, and then another thrust lower, and then a breakout up out of this triangle area. By this point in time, okay, you'd know that this is a correction, and you know that the correction is complete with a very high odds. And I'll show you why. Because you cannot count this as 1, 2, 1, okay? Because the second wave cannot be a triangle. So the fact that there's a triangle here tells you that this has to be a B wave, okay? It cannot be a second wave. So in other words, you would not expect additional weakness in this market at this time. Now, just by pure coincidence, and I think I said this in a previous video recently, triangles are the most common sub-expression for wave B, okay? So wave Bs of zigzags, of course, can be flats, they can be zigzags themselves, they can be double zigzags, but triangles are the most common thing. So zigzags are almost trying to help you out. They're saying, hey, I'm going to make my most common subdivision the type of pattern that cannot occur in a second wave position. So this is actually a fairly common thing. And if you do any kind of forecasting with Elliott Waves, this is something very useful to have in your back pocket, that when you see that triangle, you want to start thinking, okay, I've had a thrust, I've had a triangle, we're probably in a zigzag. And as soon as the market pokes its head up here, especially once we overlap wave A, it really eliminates any possibility of this being any other setup other than A triangle B, C. Now, of course, the market can go into a double zigzag. So you could have a zigzag, an X wave, and then another zigzag. However, those are quite rare. So like everything, it's probability, it's not certainty. Another thing that I'd like to point out is the fact that markets are imperfect. Okay, they follow Elliott waves very closely, but not always perfectly. And we've very carefully, with the research behind the EWAVES engine, have cataloged precisely how often the market is imperfect in different conditions. And one thing I'll go ahead and tell you, which is that third waves almost always subdivide very nicely. Fifth waves almost always subdivide very nicely. But first waves are the ones that are the most likely to sometimes have difficult to label subdivisions, okay? And we know exactly how often that occurs because I've got a database with almost 1,000 wave counts in it at this point, and the wave 1 becomes difficult to label about 8% of the time, okay? And when that occurs, eWaves defers to the outer context. So it looks at the fact that, you know, we have this beautiful channel here with this 1-3 and this 2-4, all the perfect labels everywhere else. So it says, okay, this must have been the market's best attempt at doing this initial impulsive thrust, even though it was very difficult to label these internals, okay? So I just want to be clear about that if anyone looked at that and was confused by it, but that is how the engine works. Now, in real time, we would probably expect one more new high here, but failing that, we do know that this is a wave 1 because it went to 2.14, whereas from here it was 2.08. So it did make a new high here, which eliminates the possibility completely of this being an X wave of a double zigzag. So we know at this point, okay, we're in the large wave 3 here from this point, and we know that very, very early on, even if we can't perfectly understand the internal structure of this particular wave. However, all of the other waves going forward have been very, very easy to label and very, very clean from an Elliott wave point of view. Okay, now the last thing I'd like to point out is the extreme strength of this move up in gold, okay? Now, I don't measure strength using moving averages or using RSI or any quantitative tools because those rely on periods that are numerical that you have to input. And I find that if you test different numerical values for indicators, it's kind of random as to which numbers work better at certain times and at other times. So what eWaves does is completely different because all of the analysis it does is fractal. It's all self-relative, okay? So it eliminates that problem completely, allowing for eWaves to be what we call a stationary statistical system. Okay, so most indicators are non-stationary in the sense that you're always having to change the parameters, always having to re-optimize, but eWaves is not like that. I can look at data going back hundreds of years into the past, and the statistical properties of Elliott waves then are identical to the statistical properties of Elliott waves today. So this allows us to make claims of the market is strong in a way that's going to continue to work into the future. And let me show you what I mean by strength. So in order to demonstrate the strength of this move, let me show you some channel lines that I drew. Now, normally when I show channels, they're when the market makes perfect channels, which happens quite often, okay? And what that is when you draw a line from 1 to 3, and you draw a line at the exact same slope off of 2, you get a estimated area for wave 4 where it might complete, okay? So an average impulse would look like having 1, 2, 3, and then 4 being somewhere at the bottom of this line here. Okay, that's where 4 would tend to end. Notice that 4 ends quite a bit earlier than that, okay? And this is, of course, perfectly fine. The eWaves engine looks at this channel, and it knows statistically how probable or improbable it is for wave 4 to end at different points along this line, and it weights that and balances that information against what it's seeing here in terms of this really nice triangle pattern. In this case, it's saying, yeah, I know 4 is a little bit short of the lower end of this channel, but this triangle is so compelling that evidence is outweighing that fact and saying the market is most likely to go ahead and move higher, and that's why it put the 4 in at this point. So it's not about any one particular aspect of an Elliott wave. It's really about the forest. It's about looking at all these aspects and putting them together to come up with the right answer. That's why labeling waves can be somewhat tricky for a person to do, and that's why we developed E-waves. Now, the fact that this wave 4 is not particularly large and yet very clear in terms of it being a completed pattern tells us that this market is very, very strong, okay? Because the way we measure strength in E-waves is with a wave attribute that we call linearity, okay? Linearity is a property of waves. It's very simple to calculate. It's just how far have the impulsive waves advanced relative to how far have the corrective waves retraced. Okay, it's just a simple ratio between those two. And so strong markets tend to have very high linearity. And we look at high linear trending waves as opportunity waves. And in fact, linearity is one of the key wave attributes that we use in the wave finder to look at real-time unfolding patterns, search through them, and find the ones that have very strong waves, because those are the ones that you're going to want to look at. Okay, I think that pretty much sums up everything that I wanted to talk about today with gold. Again, I think the biggest advantage of using technical analysis like this is it gives you a robust framework to look at what's happening in gold, and you don't have to do the armchair analysis of what the Fed is doing. Are we headed for inflation? Are we headed for deflation? You can just focus on the individual gold market in the same way that we would focus on any other individual market. And with that, I'd like to invite you to check us out at ewaves.com. Join us, and you can get live unfolding wave counts on gold today, reflecting the most recent price action, as well as across thousands of other markets.